Hello investors, welcome to monthly interaction with Ken Robico. Let us go through what has happened during the last month. There are several events which are critical, but the most critical aspect which is underway is the corporate earnings growth for the second quarter during the last month. Let us take them one by one. Let us start with the macro. The global macro has remained the way it has been. Of course, the incremental data points in particularly US have been more positive than negative in terms of unemployment data or in terms of consumer confidence data, also the inflation data, and that has led to probably pushing back of the interest rate cuts that we were expecting to happen aggressively. We got a 50 basis point cut, and there was an anticipation that probably incrementally if the inflation keeps sliding down, the unemployment data keeps getting better, you might get another cut during this calendar year itself. But now the consensus based on the incremental data points over last month is indicating that you will still get the interest rate cuts, but it has been pushed back a little bit, probably by a quarter or so. So the next interest rate cut should be more like Jan to March quarter. Having said this, you still are going to get probably 100 to 150 basis point of interest rate cuts over next 18 months. That's the consensus as of now. That's what is happening in US. So which has clearly translated into the 10-year G-Sec in US moving back from 3.8, 3.9% to 4.3% as on yesterday, which is a steep 30-40 bips increase, a reaction to inflation data, which has surprised negatively in terms of being higher than what was anticipated. So that's the US piece. What it means for us is also that our interest rate cuts domestically has also been clearly pushed back probably to the next year. Also, it is accompanied by the domestic inflation, which is cyclically or which is seasonally higher based on what RBI has said during the last monetary policy. So this is what is happening in US. The Middle Eastern crisis remains as it is. Probably it is getting complex and complex by the day. There is a escalation between Israel and Iran, which is happening. Let us hope that the recent Israel actually attack on Iran and excluding the nuclear and oil facilities is where it stops and it doesn't escalate anymore. And oil prices have reacted to it by actually sliding $5 to $7 during just last 1 week, because there seems to be a consensus that Israel will not attack the oil resources or oil facilities in Iran. So that's the Middle East, which is commodity or energy price positive at the margin in terms of what has happened in last month. And lastly, you have basically the Chinese part of the equation, which remains as it is. It continues to be struggling in terms of what is happening on real estate and consumption in China. And that's where this hope continues to be there, and there is anticipation that the post US election results, China will have a sizable stimulus, which a lot of people are waiting for. And to that extent, that can be commodity price positive, at least if not structurally, at least tactically. From near-term perspective. So those are the 2 or 3 key global events. And lastly, probably US election and how it pans out. By the next interaction, we will have US elections results out, and which presidential candidate wins will decide how their protectionism particularly and policies actually come up. So that's the global piece. Clearly nothing significantly changed from last month, except that the interest rate cuts might have been pushed back at least by a quarter or two, given the incremental inflation data, which is not falling at the pace at which it was expected. So that's the global piece. Coming to domestic piece, I think most of the macro data points still remain healthy. The only probably incremental macro worry, if I have to put it this way, has been that the credit cost in the unsecured piece of the loans has actually shown a significant spike, particularly microfinance. There is also at the margin increase in the credit costs for the rest of the unsecured categories like personal loan and credit card. But apart from that, there is no macro or sector specific worry. We still remain an economy where the inflation is kind of gradually coming down and coming in a zone which RBI expects us to be in between probably 4 to 4.5%, 5%. You still have external account, which is extremely good. Our CAD will be less than 1% for financial year 25. You still are running tax revenue growth of about 8 to 10% YTD, and you have credit growth which is actually running at 12-13% on a YTD basis. So most of the top-down macro parameters remain good, but as we have been alluding, the challenge remains that the economy balance sheets are in extremely good shape, but the income statement or the P&L income growth is something which is actually showing signs of actually mid-cycle tapering off or cyclical tapering off. And that's what is visible in the corporate earnings as well. So when you look at data, our economy today on a top-down basis is characterized by a very, very slow or weak mass consumption, relatively resilient luxury consumption, and relatively healthy investments part of the economy, which is real estate and the other investment part of the cyclical investment part of the economy, which is predominantly driven by government. So that's how the domestic economy continues to be. It is also reflecting in the corporate earnings that there is a income statement slowdown or there is a growth slowdown, and which is visible in the corporate earnings. After first quarter results for this year, where you had single digit earnings growth, this quarter again the earnings growth is actually panning out. Up till now almost 60-70% results are declared. It is panning out to be about 3 to 5% YOY growth in earnings for broader indices, and it remains a sign of worrying. Across most of the sectors, you have earnings getting downgraded. Even for Nifty, the earnings have gotten downgraded. Even pre-quarter, the earnings consensus has downgraded by 2 to 3%. Our sense is it will get downgraded by another 2 to 3% post the results over next one quarter. And the slowdown is visible in most of the sectors. So you have the corporate earnings season where, except few spaces like electronic manufacturing, industrials, part of auto, telecom, pharma, hotels, hospitals. These are the spaces where the earnings growth still remain resilient. But in most of the other sectors, earnings have either been neutralish to getting downgraded. For example, IT and large lenders have been neutralish, which are two large segments. But when you look at commodities, when you look at energy, when you look at the NBFCs, when you look at cement companies, when you look at the FMCG companies, when you look at the retail companies, in most of the spaces there has been an earnings downgrade. So after a long time, you have a quarterly earnings where there are more misses than hits, and so there is a downgrade cycle which is underway, and which is what we have been saying for probably last 3-4 quarters, that as your margin levers go out, if your top line is not coming in, you run a risk of earnings downgrade. And that's what you are seeing right now, that the earnings are getting downgraded marginally. Is it structural worry? Our sense still remains that it is not a structural worry. It is a mid-cycle phenomenon whereby cyclically government gave a large push. So you experience a sizable earnings upgrade on the investment part of the economy, on the real estate part of the economy, but that is yet to translate into consumption part of the economy, and exports anyways remains subdued because of the global growth dynamics. So there is a clearly earnings downgrade cycle. Now, does it changes the structural view? Our structural view still remains that we are very, very constructive structurally, and the reason for being structurally constructive is very, very fundamental. That when an economy is in a balance sheet expansion zone, when the balance sheet is not a challenge, you will gradually and slowly and directionally you will keep having balance sheet expansions. For example, in this cycle, in this business cycle, we have seen the balance sheet expansion only by government, which is through government capex. So government actually expanded its fiscal deficit, but that translation has not happened to corporates expanding balance sheet, which is private capex. The private capex still remains, while it is directionally improving, it is still remains probably a growth rate of 10 to 12% and not something which government had done, which was 18 to 20% CAGR over last 3 years. So our hope is that given where the private sector balance sheets are, we'll continue to have balance sheet expansions, we'll continue to have private capex gradually shaping up, and you will have real estate cycle continuing. Real estate cycle is still predominantly restricted to probably top 10-20 cities. Our hope is as you go through this cycle, you will actually see expansion of this real estate cycle to a full-fledged real estate cycle, and that's where you will get generally job creation. So our thesis still remains that from a structural perspective, your balance sheets are clean, your bank balance sheets are clean, your government has done the capex. Now you will have crowding in of private capex, and then eventually full-fledged real estate and consumption cycle. And since we are at the mid phase, our sense is this is a probably mid-cycle moderation of the earnings growth that you are experiencing. But given where valuations were, given where the last year upfronting of valuations had happened in the context of superior earnings growth in financial year 24, the valuation part of the market still remains expensive as compared to historical level. Just to put it in perspective, Nifty is still trading at upwards of 20 times 1 year forward earnings. mid cap, small cap indices are still trading at upwards of FY 25-26 average earnings. That clearly is expensive as compared to historical valuations. While Nifty is just expensive by say 10% versus its own historical valuations, mid cap, small caps are still expensive by 20-30% as compared to their own historical valuations. And to that extent, financial year 25 could be a year of consolidation if earnings don't get upgraded. And our view as of now remains that the upfronting of valuation that you did last year, the disproportionate return that investors got last year, have to be kind of gradually moderated. So implied expectations have to be moderated because the valuations have to correct if the earnings are not picking up and earnings are getting downgraded. To that extent, we expect financial year 25 to be a year of consolidation where the price time combination of correction and earnings rollover will take care of the excesses of valuations which have happened during financial year 24 and part of financial year 25. So that's largely from our side. You still remain in a constructive economic cycle, but you are cyclically in a year which is financial year 25 where earnings are likely to more see consolidation downgrades, and to that extent we expect consolidation in the market as well. So that's as of now based on earnings, that's our view on the market. In terms of the strength of the earnings and portfolio overweights, still the domestic cyclicals and few of the defensives remain kind of overweight in the portfolio. So industrials plus financials, large financials plus auto plus electronic manufacturing, this still remains overweight in portfolio on domestic cyclical side. Pharma and telecom on defensive side still remains overweight. And then you have smaller sectors like hospitals, hotels, aviation, which remains overweight in the portfolio. IT is kind of neutral-ish in our portfolios, where while the earnings have bottomed, you need to see more evidences of earnings uptick. Consumption remains a challenge. That's a neutral-ish to underweight, but that still remains a challenging part of the market in terms of earnings recovery. Commodities and energy is clearly the largest underweight for us in terms of some of our portfolios. So that's largely from our side for this month. Thank you, and wish all our investors a very happy Diwali. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.